But first, it's time to talk money. What should you do with the money that you cannot afford to lose? You won't get rich with that money, and you may miss out on some stock market gains, but you won't get poorer either.
Financial expert Terry Savage joins us now. Good morning, Terry.
Good morning. Well, that's why years ago I coined the term chicken money, money that you simply cannot afford to lose and you don't want to speculate with. That means short-term CDs, money market accounts, and FDIC-insured banks, and Treasury bills, which we've been talking about over the years. Easy to buy at treasurydirect.gov. In fact, there's a guide on how to do that at terrysavage.com. But these days, people are getting a little bit rattled about the safety of even their chicken money, which is the safest thing in the world.
But do you have a formula, Terry? What percentage of whatever should you have set aside? What's your thought?
You know, it depends. Here's the thing. We're pretty used to a bull market now. Just yesterday, the S&P 500 closed at an all-time high. So everybody who was saving over the years in their 401k plans thinks, well, I'm a genius. There's an old saying, never confuse a bull market with genius. So people who are now approaching retirement or in retirement are sort of conditioned to think that the market will always go higher. And it will, I believe that. But there have been some very scary bear markets in the interim, drops that take the market down quickly, 30, 40, even 50%. I've seen a few of those. And so that's a kind of a moment where you go, oh, I can't afford to lose anymore, and you sell out. That's what makes the bottom. You're less likely to do that if you have a plan. So depending on your age, the amount of money you have, the amount that you really could afford to lose, you're in retirement, you aren't putting any more away for retirement, it could be 40 or 50% of your money at that stage in chicken money. On the other hand, if you're retired with millions of dollars, you're going to pass them on to your kids. Well, that's okay. You can invest for the long run.
All right. Now that all kinds of people are getting access to the U.S. Treasury, this person says, do I have to worry about the safety of my T-bills? And what about FDIC insurance?
Yeah, I just posted a column at terrysavage.com about this. And I want to be honest with you. I understand the concern that the senior Treasury official in charge of payments just resigned, that there are all these brilliant young techies running around trying to gain access to the payment systems. Well, let me put it this way. Number one, the Treasury system, it's what finances our $32 trillion national debt by selling IOUs, T-bills, notes, and bonds, different maturities. That's the center of the global financial marketplace. They're not going to let confidence be destroyed in the U.S. Treasury system. So you do not have to worry about your T-bills. There's been talk about changing FDIC insurance amounts. That would have to be done by Congress. There is some concern about access to Social Security records, but not because, they're not coming after you to look at your records. Social Security, the real concern for me anyway, is the system is so antiquated. It's programmed in a language called COBOL, which none of these young techies have even heard of, much less understand. And if they start tinkering around with it, they could cause some major mess ups. Social Security systems are already so messed up. But as far as being concerned about chicken money, I don't think we've reached that stage, and I doubt that we will. So do not worry about your money in the bank. That's a more critical thing than having it exposed to risk in the financial markets.
All right, next question. I live in DuPage County and paid off my mortgage 4 years ago. Should I pay for title protection like HomeTitleLock.com?
Okay, so here's the concern. If you have a mortgage, nobody can take out a note, a lien against your property, can fraudulently change the title, because your bank, whoever it is, Chase or Wintrust or whatever it is, they'd have to contact them. But once you have no mortgage, your title is free and clear. And there's a long shot, and it does happen. In fact, famously, it happened to Graceland, Elvis Presley's estate, that someone switched the title to that estate. So it's raised a lot of fear for people who own their homes free and clear. You can buy an expensive title lock policy. It's like identity theft protection. You don't need it until you need it. But before you do that, check with the title insurance company that has the title to your property, because many of them, even though your mortgage is expired, have an extended period where they guarantee you against fraudulent transfer of title. So check with your title insurer first. And if you're worried, they're making a lot of money off your fear, but you might want to do it.
All right. And this person says it's now a good time to buy a new car or refinance my car.
Oh, let's take that one at a time. Headlines this morning or yesterday anyway, the president talking about more car tariffs. So you know that, first of all, we don't know if that will happen, whether these are empty threats or not. If there were to be tariffs, the price of all cars would rise, because if the price of an imported car goes up, you can be sure prices of cars around here will go up. So this might be a good time to buy a car. Or maybe not. It's not a particularly important time of the year, but this threat of tariffs might actually make it a reason to move up your decision. Now, refinancing your car, why would you do that? Rates have not come down. The only reason I can think of doing that is you want to stretch out your loan and get a lower payment, but that puts you upside down in the car, owing a lot more than the car's worth. You do not want to do that. That's just fooling yourself. So don't refinance, pay it down if you can, and buy a new car. If you see something you like, this might be a good time to negotiate before the dealers know tariffs could raise prices.
All right, quickly, Terry, how long before an economic downturn is the next question? Do you think the economy is in a recession now? Do you think the commercial real estate market will collapse like the financial collapse in 2008?
Where do you get these? Wait, let me check my crystal ball.
Yeah.
Look, the longest time between recessions was 2009 to the very short pandemic recession in 2020, spring of 2020. A recession being 2 years of negative growth, negative GDP. Oh, I can promise you this, we will have another recession. When will we have it? I have absolutely no idea. What could bring it on? Well, a couple of things could bring it on. One would be the tariffs if there was retaliation from Canada or anywhere else that could raise the cost of things that we import, like homes or even car parts and so forth. That could put people out of work and cause a recession and possibly inflation for a while. Another thing that might cause a recession, which we're hearing a lot about, massive government layoffs. Whatever you think about the politics, I'm just talking economics. These are people with jobs who live in their communities, who buy cars and so forth. So if you begin to see a massive wave of layoffs, even in the government, that could also trigger an economic slowdown.
Yeah.
So we know there'll be a recession one day. There's no crystal ball. Recessions in the stock market are not linked immediately. So you have to keep your eyes open. That's all I can say.
All right, to ask Terry a question, go to terrysavage.com. Thanks, Terry.
Thanks.
Thank you, Terry. Time now for Around Town.
Hey, Anna.
Good morning.